For years, the XRP community has been surrounded by some of the most controversial and misunderstood narratives in all of crypto. One of the longest running and most polarizing of these is the so-called 589 theory. Most people immediately assume this theory is nothing more than a prediction that XRP will someday reach $580 per coin. That assumption alone is part of why the XRP community has often been labeled as irrational or conspiratorial, but the reality is far more nuanced. The 589 theory, when examined closely, has little to do with price targets and much more to do with how liquidity, market structure, and systemic stress may ultimately converge. Before diving deeper into that, it's important to ground the discussion in the present market context. Earlier today, I talked about the broader crypto market and highlighted several forces currently at play: supply and demand imbalances, ETF flows, and the way capital has been rotating across asset classes. From a technical standpoint, the chart I'm watching most closely right now is the 4-hour time frame. XRP is still holding its uptrend there, and that matters more than most people realize. The structure hasn't broken going into the new week. The key thing I want to see is higher highs on the lower time frames. Specifically, reclaiming $2 is critical. A daily close above $2 would be far more significant than it appears on the surface. That level isn't arbitrary. It flips a resistance zone that has been intact since late November, reclaims a support channel that's been guiding price action for months, and aligns with major historical support from last summer. When XRP previously established a strong base above $2, it triggered a run that took price north of 360. That didn't happen overnight, and if it happens again, it won't this time either. But structurally, that's how strong moves are built, step by step, base by base. Right now, XRP has already printed a higher low on the daily chart. All that's missing is a higher high to flip the structure fully bullish. That's why understanding these signals matters, not because they guarantee an outcome, but because they reveal how capital moves when systems strain. And if you want to be positioned the way the top 1% position before narratives become headlines, you need more than surface level analysis. That's exactly why I put together the 100x Investor Bundle, a curated set of exclusive documents, videos, and infographics, breaking down how asymmetric wealth is actually built, how insiders position during liquidity shifts, and where true 100x opportunities emerge before the crowd sees them. It's designed for serious investors who want clarity, not noise. It's available in the video description, and if you use code Millionaire, you'll unlock a special discount. Now, this is where the conversation shifts from charts into narrative and why the XRP community has remained such a lightning rod for debate. Over the years, XRP holders have latched onto riddles, symbols, cryptic images, and anonymous posts. One of the most infamous sources of this speculation has been Bearable Guy 123. On December 24th, a new post from that account went viral almost instantly, racking up millions of views and massive engagement. The image itself is packed with symbolism, but the centerpiece once again is the number 589. To be clear, I don't trade based on riddles. I don't look at images and conclude that XRP is about to teleport to some absurd valuation. Markets don't work that way. Fundamentals, liquidity, macro conditions, and structure matter infinitely more. That said, dismissing recurring patterns outright is just as irresponsible as blindly believing them. The number 589 has shown up repeatedly, and not just in fringe corners of the internet. Brad Garlinghouse, Ripple's CEO, has followed exactly 589 accounts on social media for years. That number hasn't changed. Moon, a company deeply integrated into crypto infrastructure and openly supportive of XRP and RLUSD, recently highlighted 589 bulbs during a New Year's Eve broadcast. Not 588, not 590, exactly 589. Even more unusual, mainstream media explicitly counted the number of bulbs used in the Times Square display, something they almost never do. The reporter even remarked, "I don't know why we need to know about this." That alone wouldn't mean much, except the post was reshared by MoonPay and acknowledged by Caroline Pham, former acting CFTC chair who has direct historical ties to Ripple and Brad Garlinghouse. This isn't random retail speculation bouncing around Telegram groups. These are institutional adjacent figures interacting with the same symbolic reference. And this is where the real meaning of 589 begins to emerge. The 589 theory isn't about XRP hitting $589. It never really was. It traces back to COMEX Rule 589, a little known but extremely important regulation governing price fluctuation limits in futures markets, particularly metals like silver and gold. Rule 589 acts as a circuit breaker. When price moves too aggressively in too short a period, trading is halted for several seconds to prevent disorderly markets. These pauses are especially critical during contract settlement periods where volatility can spiral out of control. Why does this matter now? Because silver, gold, platinum, and palladium are all experiencing historic near-vertical price movements. Silver alone has surged toward levels that were previously unthinkable in such a short time frame. We're not just talking about new highs. We're talking about price behavior that signals systemic stress. When multiple precious metals move in unison like this, it's rarely speculative hype. It's usually a sign that something deeper is breaking beneath the surface. The underlying driver is supply. Silver has been in a structural deficit for years, with demand exceeding supply annually. In 2025, global demand is projected to exceed 1.2 billion ounces, while supply struggles to reach 1.01 billion. That gap is widening, not shrinking. Mining can't scale quickly. Recycling can't fill the void. Inventories are collapsing. COMEX silver inventories are down roughly 70% since 2020. London vaults are down around 40%. Shanghai inventories are at decade lows. In some regions, usable supply represents little more than a month of demand. At the same time, China, responsible for an estimated 60-70% of global silver supply, is tightening export controls starting January 1st. Only state-approved entities will be allowed to export silver. That alone removes tens of millions of ounces from the global market. Layer on rumors of potential U.S. export restrictions, and the supply shock becomes impossible to ignore. This is where paper markets collide with physical reality. The paper to physical silver ratio is estimated at over 350.1. For every ounce of real silver, there are hundreds of paper claims. If even a small fraction of participants demand delivery, the system fails. Markets know this. That's why price action is becoming vertical and why COMEX Rule 589 suddenly matters. When volatility exceeds predefined limits, trading halts, liquidity dries up, confidence erodes, and when traditional market sees under stress, capital looks for alternative rails. This is where XRP enters the conversation, not as a meme, not as a magic price target, but as a potential liquidity tool in a world increasingly aware that the existing system is fragile. Whether XRP ultimately plays that role at scale remains to be seen. Betting everything on that outcome is dangerous, but ignoring the convergence of metals volatility, liquidity injections from the Fed, and accelerating tokenization efforts would be equally naive. The Federal Reserve has already pivoted away from quantitative tightening. Liquidity is being quietly injected back into the banking system, just as it was in early 2023 when cracks first appeared. This isn't theory, it's observable. And historically, periods like this are when wealth is redistributed, not to those chasing narratives, but to those positioned early in real assets and asymmetric opportunities. What's important to understand as we move forward is that markets don't break loudly at first. They whisper. The metals market is one of those whispers right now, and historically it has always been early. Gold, silver, platinum, and palladium don't move like this unless confidence somewhere else is eroding. This isn't just about inflation hedging anymore. This is about trust. Trust in settlement, trust in delivery, trust in paper promises. And once that trust starts to wobble, capital doesn't wait for confirmation, it relocates. That's why it's a mistake to look at silver's move in isolation. The same structural stress exists across bonds, derivatives, and even equities. But metals expose it first because they sit at the intersection of physical reality and financial abstraction. You can rehypothecate paper claims endlessly until someone asks for the real thing. When inventories are thin and demand accelerates, price becomes less about discovery and more about survival. That's when rule-based mechanisms like COMEX Rule 589 are forced to step in not as a signal of control, but as an admission of fragility. Now zooming out, this environment is exactly why digital asset infrastructure has been advancing so aggressively behind the scenes. Tokenization, real-time settlement, and on-demand liquidity aren't buzzwords anymore. They are solutions to problems that legacy systems are increasingly incapable of handling. The reason institutions have been quietly building, testing, and integrating blockchain-based rails isn't ideological. It's practical. The current system is slow, opaque, and brittle under stress. When volatility spikes and liquidity evaporates, delays become losses. XRP has always sat in an uncomfortable position in this conversation because it doesn't fit neatly into the speculative crypto narrative. It was never designed to be a meme, a store of value clone, or a DeFi casino chip. Its purpose has always been transactional, bridging liquidity, reducing friction, and enabling settlement at speed and scale. That makes it boring in bull markets driven by hype and suddenly very interesting when systems start to strain. This is why so many people misunderstand XRP's cycles. It often lags during euphoric phases because speculation chases narratives with the fastest perceived upside. But during periods of structural transition, when capital starts prioritizing reliability over novelty, assets like XRP come back into focus, not because of promises, but because of utility. Whether that utility is activated at scale tomorrow or 5 years from now is less important than the direction of travel. And that direction is clear. We are moving toward a world where tokenized assets coexist with traditional finance, where settlement windows compress from days to seconds, and where liquidity has to move globally without friction. Central banks, regulators, and institutions aren't debating whether this will happen anymore. They're debating how fast and who controls the rails. That's also why the constant dismissal of XRP community narratives misses the point. Yes, some of the symbolism, riddles, and speculation are over the top. But beneath the noise is a group of investors who identified early that the plumbing of the financial system was going to change. They may not always articulate it well, and they may sometimes overreach, but they weren't wrong about the direction. This is not financial advice. The irony is that the same people who mock these discussions often accept far more fragile assumptions elsewhere. They trust that paper markets will always honor delivery. They trust that liquidity will always be there when needed. They trust that central banks can indefinitely manage complexity without consequence. History doesn't support that confidence. What we're seeing now across metals, rates, and liquidity injections is not a collapse, but a transition. Transitions are messy. They involve overlapping systems, temporary distortions, and moments where prices move in ways that feel irrational. But they also create opportunity for those who understand positioning rather than prediction. That's the real takeaway from the 589 conversation. It's not about a magic number or a guaranteed outcome. It's about recognizing stress points in the system and understanding which assets are likely to benefit when those stress points widen. XRP may or may not be the ultimate beneficiary, but assets tied to settlement efficiency and liquidity almost certainly will be. And this is where 2026 becomes critical. We're approaching a period where multiple long-term cycles converge. Debt refinancing walls, geopolitical realignment, technological adoption curves, and generational shifts in capital allocation. Wealth isn't created during the panic phase. It's created in the positioning phase before the panic becomes obvious. Most people wait for certainty. By the time certainty arrives, the asymmetry is gone. The biggest gains have already been priced in and risk-reward flips. The top 1% don't wait for headlines. They study flows, infrastructure, and incentives. They allocate when things feel uncomfortable, not when they feel obvious. That's also why simply holding crypto isn't enough. Asset selection, timing, and understanding narrative shifts matter more than ever. There will be winners and losers even within the same sector. Some assets will capture liquidity, others will dilute it. Knowing the difference is what separates exponential outcomes from mediocre ones. As metals continue to expose cracks in the old system, and as liquidity quietly migrates toward new rails, the gap between informed and uninformed investors will widen dramatically. This isn't about predicting a single event. It's about understanding a multi-year transition and positioning accordingly. And if you're serious about playing that game at a higher level, this is exactly why I built the 100x Investor Bundle. It's a deep dive collection of exclusive documents, videos, and visual frameworks showing how the top 1% identify asymmetric opportunities, position during liquidity shifts, and build real 100x outcomes before narratives go mainstream. I